just introduce yourself in just in a minute and just tell them what you do and what you're interested in when you look at startups.
Thank you for having me today. I'm really excited to be here. My name is Sarah. I work with a venture capital fund called Atlantica Ventures. We are a Pan-African, tech-focused, primarily B2B investors. We've invested in cybersecurity, IoT, healthcare, fintech, so quite a broad mandate there. And I'm one of the senior associates of it on the team. I've spent pretty much my entire career working with early stage and growth stage companies. So previously, I was supporting early stage companies to raise capital, now kind of sitting on this other side of the table. So quite excited to be here with all of you. Thank you.
Can you guys hear me? Hi, everyone. Excited to be here as well. My name is Philippe. I'm a senior associate at TLcom, which is a Pan-African fund making equity investments in early stage up to B. I was particularly excited to see this event as I swam against the stream, so to speak, just recently. Graduated from business school in Palo Alto and was submersed in the Bay Area culture of startups and innovation and decided to come back home, which is not a very typical path for those in my world there. So looking forward to speaking about how the two worlds connect. And as far as my work at TLcom, we invest in everything, sector agnostic, relatively stage agnostic as well, but looking for founders that are using tech to solve the continent's largest challenges in both the consumer and enterprise space.
Hello? Okay. My name is Sendai. I work for EchoVC. I've been doing VC for about 5.5 years. Before this, I was doing private equity for about 3 years across Africa. And we've been investing seed, pre-seed, also Series A across the continent, based in Lagos. So we do mostly West Africa and East Africa.
Hi, everybody. My name is Mia Kimani. I'm the managing partner of Future Africa. Future Africa is actually an early stage fund, so we mostly invest at pre-seed stages. We also run an accelerator, Accelerate Africa. That is our primary sourcing tool into the fund, where we run a cohort every 6 months of 10 startups. We invest sector agnostically, very early stage, although we have by now seen our fair share of startups that have gone from founding stage to unicorn. We have had 3 now, almost 3. Very focused on the $0 to $1 million revenue stage and setting everybody up for growth from there.
Cool. Okay, thanks, guys. So just to build on the last panel, there was one comment which talked about profitability versus growth. Love to hear from you guys about the battles or the challenges that you see around that. And then couple with that a second question, which is around what do you see as the biggest challenges to scale? Do you want to go first, Mia?
Sure. I mean, I think this question really depends on the market, right? As we all know, capital is incredibly scarce. So there is not too much space for high growth, super unprofitable business models because you're likely not gonna find the capital to get there, right? So right now, there's a much bigger focus on profitability, maybe at the expense of growth, but I think sometimes if you can be profitable early on, you can also grow faster, right? Because that sort of fuels the engine and proves out that you can get there. So yeah, I think for us, we look at both, which sounds sort of ridiculous, but that's what it is. But I think there's no or limited funding for businesses that sort of need to get to $100 million in revenue to become profitable. And we have seen also that it often doesn't really work.
Okay, Philippe, do you want to just given we are at Silicon Exchange and you are from the Valley, you've been at school in the Valley, let's talk about the differences.
Sure. I think so. To agree with you, I think this question around profitability or growth is one where we talk about a cold funding environment and what that means for a broad transition towards profitability. What you don't hear in conversations from investors is that they're looking for both. They're looking for growth alongside profitability. Maybe that doesn't mean that you're EBITDA profitable, but you are on a gross margin. But I think that conversation is kind of been broadly explored. I think generally some of the challenges that we see for scale are more around planning and forecasting around capital requirements. And so I think in 2024, I think our founders in Africa do a phenomenal job painting the picture of the size of the problem. As Mabola mentioned earlier, the TAM, how big the problem is, the depth of the problem and the opportunity. I think where we need a bit of work across our market is understanding what competitive advantage, being able to articulate what competitive advantage your company is positioned to capture. So whether that's a cost or a value advantage, what about your cost structure, your strategy, your partnerships, or your expertise in-house allows you to position yourself to offer the same product at a better price, or offer the same price and have a perceived higher value. And I think from that comes this idea of how do you plan for fundraising, not just this round, but future rounds. A lot of what we see around emergency bridge rounds or cash-strapped companies, those problems come a few years before the problem actually arrives. What is your North Star? What actions do you need to get there? Do you need to budget in room for acquisition or inorganic growth? What key hires do you need on your team? What does that mean for what you're raising this round? And it's not enough to say, ed techs at Series A raised 10 to 15 million, so we're raising that. That needs to be a bottom-up exercise. And to your point around scale, I think that helps companies avoid having to go back to market early, which hinders companies in more ways than one.
Yeah, the growth versus profitability debate. So I think, as kind of what has been said, the growth is expected at each stage. No one wants to invest in a company that's not growing. No one wants to buy a company that's not growing. So at each stage, I think the growth piece is important. And in terms of profitability, I'd say that it kind of, we like to look at it more from like a capital efficiency standpoint. So like in the very early stages, how are you making each dollar that you've raised count? What is it actually helping you achieve with that North Star in mind? So anywhere from, I guess, in those initial stages where you're looking for product market fit, you've raised this much. How has that helped you achieve that milestone? From Series A to Series B, for example, you're starting to scale. You said you wanted to go to these key markets and you're trying to build your customer base from X to Y, or you're trying to grow your revenues from $1 million to $5 million. How has the capital that's come into the business actually gotten you closer to that goal? So the net profit kind of line starts to become more important, I think, as the business is like much larger. But the capital efficiency is important from the get-go. So having that clarity of these are the milestones between year 1 and 2, between year 2 and 3, I think that's super important, kind of in line with that profitability question. And then in terms of the challenges that we've seen, I think getting the sales engine right, we've seen is actually quite difficult. And by sales engine, I mean, how are you segmenting your customers? How well do you understand your large customers, your medium-sized customers, your small customers? Who do you actually want to sell to in that whole range? And how are you going to get to them? If it's your sales pipeline, what does that process look like in terms of distilling that from, we think we can reach this 100 customers, but these are the ones we want to target, and this is how we're going to target them. These are the salespeople that we need to bring in to target these specific customers. It's building a repeatable sales process where usually when you're starting out, the founder holds a lot of the relationships, but as you start to move from 50 to 100, 100 to 1,000 plus customers, that kind of has to be cascaded down. And so you need to have a process that's more repeatable. This is how we reach out to our customers. This is at the point at which we do a demo. We get these indications, and these indications tell us that this is what the conversion rate could be like. So I think that sales engine is kind of what we found has been one of the more challenging things to build out.
Cool. Sendai, what are your thoughts on that?
Nothing to add, just I think everyone said profitability. Usually as VCs, what we mean by that is just making sure unit economics are working. So on a per unit basis, are you making money, or do you have a path to see that working? And if it's not working, then that's a big problem. But nothing else to add, really.
Well, Mia, you had an additional point?
Yeah, maybe just something to add what that means concretely, right? And which business models sort of work well that can get you to both profitability and growth. And what we have seen across the portfolio is that the companies that have sort of grown really fast and gotten there usually had one big anchor client at the very beginning. And that was usually a corporate. So that they worked really well, that had the funds to pay, and then they worked their way to other corporates and more diversification from there. I think right now, a B2C model where you don't have maybe a business customer that can give you that distribution model quickly is just something very expensive and very difficult to build in this environment.
Yeah, I agree with that. Sendai, given your Lagos and Nairobi split, we just talk a little about cross-border expansion and the challenges that you see around that in this massive continent that we live in.
Yeah. So I think typically for our VC, we like to find ambitious founders. It's very rare sometimes to find a founder that's maybe they begin in Kenya, they begin in Tanzania, they want to scale outside around Africa. I think a lot of founders are intimidated by that. So it's not easy. What you have to do essentially is try to find the right people and the right team to be able to help you execute in that new country. So who has good relationships, good network, they know who to talk to, who not to talk to. That's, I think, the most important part that we've seen many of our companies struggle with. The founders that are trying to get into new countries are just struggling to get who is going to be the country lead to help me execute on the ground.
Okay, and I guess, Sarah, you talked a little bit about partnerships and that sales engine. How much do you, both you and Philippe, how much do you guys handhold your growth founders through that process? And how much machinery, like in terms of advisory machinery, do you put around that?
We do a lot. I think first off, it's making those introductions and opening those doors. I think in the previous panel, it's Ricardo who said that your investors are supposed to be helping you with your business development, and really they should. They should be helping you open those doors. If it's reviewing contracts, for example, understanding kind of what does this partner actually bring to the table, having that external view, I think, can be helpful where we're not so involved in the day-to-day, and therefore we're able to think more strategically with you on whether this partnership actually makes sense or not. I think oftentimes also founders are doing this for the first time, and so having a network of people, not just within the fund, but even at investment committee, for example, we have someone who's scaled so many SaaS companies, software as a service companies, and sold them, and so they understand how to actually build some of these partnerships. So we do a lot of kind of introductions and advisory in that capacity. Yeah.
Okay. Philippe?
Yeah, not much there to add. I was recently looking at a survey, I'm forgetting the source, but saying, founders globally look, when you think about VC value add and where investors typically add value, there's kind of large agreement that it's on supporting follow-on investment, right? So some of the day-to-day operations may be less suited to do, but for us, a lot of the relationships we foster and partnerships have to do with setting up founders for future rounds, and we're now in our second fund and have a lot of companies at later stages, and so whether it's partnerships with the London Stock Exchange that we're now establishing, or bringing in strategics that we have introduced as execution partners earlier on to other portfolio companies as potential acquirers, getting those conversations started early before they're actually needed is something that we do a lot of as well.
Okay, that's a great point. I think as someone that spends a lot of time in M&A and helping startups through that process, how early do you start in that process, Mia, when you look at a business and you're going to invest? How early do you start having that question around exit planning?
So I think there's a difference between the company having an exit and we as an investor having an exit, right? So for us, obviously, we invest super early. So we typically exit at Series A, B, maybe C. Typically B is sort of the sweet spot. But obviously, for us to exit to another investor, they also need to have an exit path, right? So that's sort of the overall conversation. We actually, funny enough, we think there is quite a bit of potential of local exits in the futures, which is sort of very unexplored at this point. So we spend quite a bit of time with the various local exchanges, because what we learned sort of from the IPOs that we had across, right, is they often don't work really well for our startups, because an IPO is typically driven by investors wanting to buy into the product, right? They like a piece of Apple, or they like a piece of this, what they know. But they have no clue what IHS is, right? They don't even know where Nigeria is. When something happens in Niger, the stock tanks, right? That's actually what happened. So that's important. And obviously, because we work so much with corporates as sort of these anchor clients, there's also a natural exit path. If you think of a move, maybe an Uber that just invested, right? Could be a natural exit. It doesn't have to be, but it could be, right? So I think the corporate part is also very important.
Okay, Sendai?
So the way we think about exits is, as a VC, like we're looking for a certain return in order to perform at the fund level, to hit our metrics. So we like to basically aim for around 10x return, which is a bit high. But for the
Good
VC,
to aim high though.
it's for our portfolio and just the VC in general, 1 out of 10.
For the fund or the companies?
For the company. So 1 out of 10 companies are going to do well. The rest are going to stagnate or fail. So for us, we have to find that sort of 1 out of 10 company that can do really well and make more of those bets, which is very difficult. So if we see an outcome for 10x or more, we will take it. I think exits have been very difficult right now because the seed, pre-seed investors are getting penalized when it comes to exits by later stage VCs. And so we can't really get our returns because they will give you a valuation much lower than what they're doing the valuation for the round. So it's been difficult. So, but that's what we look for in terms of our exits, yeah.
Okay, Philippe?
Yeah, I think just one thing to keep in mind when you think about exits, maybe in a U.S. context, given the context of this conference, I think it was in 2020 or 2008, there were roughly 1,000 seed companies in the U.S. Over a 10-year period from that, there were roughly 30% of those had exits, and of those, 10% of them had exits above $50 million, and 1% of them were unicorns. We talk about a dearth of exits in Africa, and there is a dearth of exits. There's a dearth of high-value exits. Interestingly, there have been exits at a high clip, but it's typically not for a similar amount of value. When you look at India, over the last 10 years, they've seen similar ratios, but a lot of the exits are in kind of local M&A. If it's IPO, it's kind of local as well. And we look to that market as a good corollary for what's happening on the continent. So we're not looking for international IPOs to happen, and in the case that they do, they will be facilitated. They're not going to just happen organically. And then on the local M&A side, to echo Mia, it's very much, I think investors have much more of a hands-on responsibility here than they would in more mature active markets like the US. And there's a broader interesting question. I think we saw a 50 or 45% decrease in seed rounds raised in the last year. And if you think about the lagging indicator for what that means, for what that gap creates for Series A, Series B, and Series C companies in the next 10 years, the numbers and ratios I mentioned for US companies, about 30% of them getting to exit, which roughly mirrors emerging markets, that number should tank in the next few years, given that the amount of seed companies that we're able to raise has also tanked. So there's also just a question on, when you think about exits, it really starts with supporting investments at the seed level, seed and A level. So maybe not our direct strategy, but the investments we make now, I think, are propping up future exits, hopefully for follow-on investments we make in future funds.
Yeah, I think that's a really interesting point. 2 minutes. Sarah, just pivoting. We're in the growth stage, right? You've got a couple of investments. They're struggling. You talk a bit about, they're struggling to kind of find their next customer. Maybe they're trying to go cross-border. How often do you see the kind of pivot, and how do you deal with that?
So I think the important thing when you're looking to pivot is to remember that you still need to protect the core and leverage as much of the core capabilities that you have to support this pivot. Why? Because we are in a market where, like has been said, the capital is not always going to be freely available where you can get it within a month, 2 months, 3 months. And so how I'd think about a pivot is, okay, we want to explore this new business line. We think there's opportunity here, but this is our bread and butter today, and we still need to make sure that that's protected, but you're doing it much more efficiently. So that gives you then the room to start to build out these other lines. Internally, I wouldn't say we've seen like major 360-degree pivots. What we have seen is that at the later stage, we're seeing some of our businesses start to invest more heavily in other business lines where they kind of got the indication like this is it. But at this point, it's not a bet, it's not a gamble. We kind of have very high confidence that this is where the business needs to go. And so we still see revenues from the core business. It's just growing kind of more steadily as opposed to like high growth, but they're investing much more heavily in this new business line. They're bringing in more managers to build out this new business line or to build out this new product, to build out this new market. So that's kind of what we've seen internally with regards to pivot, yeah.
Great, and in terms of the startups that you're working with, how often do you get asked the advisory board question, guys? Are they ever asking you, they've got founders, they've got their growth capital, they're now thinking, do we need a group of advisors? Like, at what point does that kind of happen in your journey?
Day one. Day one. I mean, founders need a support system, right, around themselves. Single founder especially, but also small groups. They're never great at everything, and they shouldn't be, right? They should be great at a few things and be extremely good at it. So we always the best founders always have a group of trusted mentors that sort of fill the gaps. I think from day one, whether you call this an advisory board or just a bunch of friends that help them on a very committed basis, and then it gets formalized. I think that's what we commonly see. And if we see there's major gaps and we don't want to bring them in on the team, or it's not necessarily necessary on a full-time basis, we will definitely recommend that and make the introductions as well.
Okay, Sendai, if you see a business that has an advisory board of people, looks fairly organized, is that an indicator of a business you think actually there's a little bit more governance there, and we should be looking at this business in a bit more detail?
Yeah, I think it's definitely a good signal to have. So just my perspective is doing pre-seed, seed, a little bit of Series A. Now, typically, I don't see these types of boards until much later, Series A, Series B. And also for us, the type of founder we're looking for, I guess, paradoxically, they don't really need that much help. So like they're super obsessed, super driven, they know the spaces really well, and they're able to execute. And then we give them advice when they ask for it, but ideally they are getting advice from different things informally and then making their own view because they know best as a founder what's happening on the ground, and they know their market the best as well. So it's a good signal, I think, for sure, but we typically don't see it.
Okay. Philippe, culture and values. In the US, US investors, UK investors, we talk a lot about culture and values. How much do you see that as a driver on the continent for growth?
Yeah, I mean, I'll couple that. I mean, it matters is the short answer. I'll couple that with a question on the advisory board. When it comes to talent, when it comes to investor partners, it matters less that you have a board than you have people that are aligned, in my view. There's nothing worse than a strong governance body with a perfectly credible board of people with different North Stars for your company. We see kind of at Series B and beyond when you have a PE investor, a couple of friends and families that have stayed on as respected advisors, a couple of VCs in between. Some are exiting with secondaries. Others have a long-term return expectation for the companies, and others are looking to sell to a strategic. There's a lot of wisdom in that room, but it's not necessarily existentially healthy for the company. And I think that reflects a broader point on culture. I think number 1, 2, and 3 of the things that you want early is kind of the strongest talent you can find. Models pivot, people with strong values and that are going to stay committed. And these are generic things, right? You hear them all the time, but you'd be surprised how often both investors and founders forget to make sure the rooms stay quite tight with the strongest people from a values and competence perspective possible. I don't have anything groundbreaking on culture, but those are my reactions.
Sarah?
Yeah, I agree 100% with what he said about making sure the voices around the room are actually aligned with the founder. I would say with culture, the important thing for me is to be intentional. What do you actually want this culture to look like? Your hiring needs to be aligned with that. Your performance management needs to be aligned with that. Yeah, that's all I have to say about culture.
Great. So that word intentional's come up in 2 panels around investors. So I think the message here is be intentional, I think, for sure. We've got 3 minutes before we take some questions. Can we just talk a little bit about success stories? Mia, do you want to go first and just talk a little bit about the success stories that you've had and the kind of key drivers for that success?
Yeah, I mean, I think I talked about it a little bit already in terms of how do we set us up and how do we get sort of, it's like a horse race, right? How do we get out well and quickly and without stumbling? And that's definitely been the corporate side. And then I think at different stages, different things come in. So if I take a Move, for example, right? Move was started about 4 years ago, is now basically operating across the world on a problem that was very Lagosian and turned out to be a problem across the world in emerging markets, but also in development markets, particularly for immigrant populations that make up a large share of the driver population. And I mean, I think there was a very strong team, very experienced team. That's important. There was very quick early traction and an anchor client that gave a lot of trust that made it easy then to fundraise, that then gave the capital to scale up. So, right, having these ingredients in place early is, I think, very important. And you need to know investors have a very strong herd mentality, right? If nobody has admitted, that's really what happens. And so once there's sort of word out, this is a great company, suddenly everybody wants to be there, right? Sort of there's also sort of the image. Obviously, the numbers need to follow, but there's a big part of that. And I'm seeing that in my latest fund portfolio. I have a company that grew really fast, very impactful, and so everybody says there's no capital, but I actually have to tell them, stop taking investor calls, just build the business. Because once you get to that stage, there is capital, right? And it's not limited to Africa. Now suddenly they become interesting for everybody outside. So I think walking that journey is important with these key ingredients.
Cool. Sendai?
So I guess for success, the way I define it is more around exit. And to be honest, I haven't personally had an exit yet. I think the most exciting company in our portfolio that I've done is a crypto fintech hybrid. Just really exceptional founder, super obsessed. He used to work at Yellow Card, so he helped launch their Nigeria business, and then he's been scaling tremendously. So he raised from us just a small ticket, and then he didn't raise after that, but he's doing almost around 10 million revenue so far, so it's been really impressive. I think that's my best.
Yeah, I mean, I absolutely agree that exits are the metric in where we are today. I'm going to take a broader approach to the question and just like the sober reminder of where we are. Low disposable income, fragmented markets, lack of digital tools. We all know the stats. Is it a demographic dividend or a demographic boom? Again, to anchor us in the conversation today, Elon Musk bought Twitter for $44 billion. I think the same year he did that in 22, we had $5 billion flow into our ecosystem from a VC perspective. So one of my personal metrics for success, which is maybe misaligned to my firm's metrics, which is way more around exits, for where we are today, having the majority of our portfolio company founders be repeat founders that have started companies on which the lessons are being learned. Is it consumer, is it enterprise, do you go through partnership, acquisition, et cetera? These lessons have been learned by founders in our ecosystem, and it takes those lessons, that mentorship, that kind of capital being recycled into the continent, and frankly, the narrative of what African VC and tech is, like that is our asset, right? Being able to keep and maintain a narrative that allows the type of funding that will lead to the types of exits we're all here to be a part of. So repeat founders, lessons learned, larger tech community.
I think we have some companies that I'm quite excited about. One of which I would say is exciting because they've built a product it's a global product. Like anyone can build this. And so how they had to differentiate themselves was with building a business model and a sales engine that actually allows them to get as many customers as possible and retain them. And I think what made the difference there is they have a very strong team. Again, repeat founders, very strong operators, very data-driven. So they've been good at kind of collecting the metrics that matter and distilling down all their data to understand the customers really well and build kind of features that matter for the customer. So that for me is a success story just because you took a product that's in a very competitive global space and you're able to differentiate yourself by how you actually bring it to the market. Yeah.
Great. I think we're a little bit over time, but have we got to take some questions?
Okay. Sorry, I'm going to take this one. My name is Augustine. I'm with the Silicon Xchange team, and my side gig is leading deals for the Black Angel Group, which is one of the larger Black Angel syndicate in America. We have membership across the world and also building a venture community with Black VC, which is a national nonprofit organization in the US as well. My question is around how you navigate and handle failure from your founders. It's obviously known that in the US, majority white founders get funded, and if they fail, it's like kind of like a badge of honor. Like, yes, you learn from your failure, but it's difficult to extrapolate that kind of same thing to Black founders in the US. And so I'm curious on how you are, as stewards of funds, looking at innovators on the continent, in Kenya and beyond, how do you manage a failed founder? And I'm asking that because it has a profound impact in their ability to become repeat founders. And oftentimes, repeat founders are successful founders. And so I'm curious to know how you approach failure, because failure is a motivator for me. I like to learn from failures, and I actually embrace failure and encourage others to fail often and fail fast. But from your venture standpoint, how are you managing failures? There are founders in this room that are going to fail. They don't know it yet, they will. But if they're in your fund, how are you managing that and massaging that to encourage them to keep going?
Yeah. So my favorite is actually first-time failed founder, now second-time founder, because they tend to produce the best results. I'm very wary of first-time successful, now second-time founders, because they typically feel they can beat the odds, right? Sort of, they know this thing, right? But your chance of failure is still pretty high, even if you're a second-time founder. But I think sadly what I've seen also when founders fail is that they get blamed a lot, right? Because the VCs need to justify why they failed, right? And then the founder is the easiest target. So I've seen this now quite a few times, which is quite sad. And we sort of have then always funded them for the next venture as a general rule. If they ask us for funding, not everybody necessarily needs or wants or whatever the situation is, but I had one concrete case just now where it really went through the press, has failed, la la la, and it was really quite bad. And I've gotten a lot of, why are you investing in this founder? But personally, I mean, unless there's something unethical or why the company failed, assuming that's not the case, I think these are the strongest founders, right? Because they also have this inner drive, they have something to prove, and they have all this experience from the previous example. So that's sort of been our general policy for that, and I think we should all, support that more, right? And, but every case is also different. Maybe somebody has learned from the experience that maybe they should not be a founder, right? For whatever reason, and they would be better in a different environment. That could also be the case, right? So we try to really have these honest, what has happened, what have we learned, what does that mean conversations. And in most cases, they make great second-time founders, and we will fund them.
Yeah, I think it's a good question. And my first reaction was, how are you defining failure? I think the entrepreneurial journey, as you guys will know way better than me, is extremely hard. We are in a sector or a space of failure. Many of the companies that we invest in become write-offs despite us going in having to make the business case for why this could return the fund. Majority of founders won't kind of reach their long-term ambitions for the company. Like, we are in a space of failure. And for me, the ability to take big bets on high conviction opportunities and actually put your money where your mouth is around that, I just don't see that as a failure. Again, outside of the egregious, ethical ethical issues. But I love second-time founders. I love third-time founders. The failure piece for me is not seeing someone come back and try something else. For me, I don't see that as failure.
Hi guys. Hi. So really quickly, Anthony from Rocket Jobs. I wanted to ask. I wanted to actually mention the U word, unicorn. I know that's a bit of a taboo word, especially like in African circles. But really quickly, Estonia, small country, 1.4 million people, has 10 unicorns so far. Africa, 1.4 billion people, has 8. Do you think there's something we're doing wrong as builders? And if so, what?
I wouldn't say something we're doing wrong. I think Africa is just very difficult. It's very fragmented. Those founders from Estonia, they built companies that became global companies. So you have to have founders. You have to have ambition to actually build a company, not just for Africa, but I'm going to go into emerging markets. I'm going to go into the US. That's what you need to do. To build a unicorn in Africa is really, really hard. For example, Kenya, we haven't really seen one yet. And Nigeria, I think, has a few. SA has a few, I think. But it's been very difficult. So it's, I think it's down to the ecosystem. It's very early. But also the founder ambition, I think, needs to also be cultivated.
My name is Karaoke. So I'm interested about, from your perspective, what would you classify as, I'd say, weird behavior from VCs, right? And this is really in relation to how they treat founders. For example, I've heard people of late, a pre-seed round, then the founders didn't do too well, then they're being forced to return the money, things like that. So what sort of investors or characteristics from investors do founders need to watch out for?
I think, as has been said before, this is one of the most close relationships that a founder will have in their lifetime. Because if you're looking at a journey of 5-10 years, that's a really long relationship. So it's important to kind of get to know who it is that you're getting in bed with, if I can use that metaphor. And that means that from the onset, it's actually building that relationship. I know the culture in the past has been that, you take 3 weeks, you meet this investor, they give you money and you go. But as early as possible, start to actually get to know these people, get to know the associates, the senior associates, the partners who are likely to be sitting on the boards, and know them as individuals first. I'd say red flags are investors who think they know your business better than you, as opposed to kind of adding to what you already know. Investors who are don't share much about kind of what they're looking for up front. You ask them questions about what is it that you need me to kind of show in order for you to invest. I think that kind of maybe secrecy, if I can put it that way, is a show that this is not necessarily someone who wants to partner long term. It's a two-way street. The information that you're asking for it's not too much to ask for, because we also ask a lot of questions. So the same way that you would think about any other relationship with anyone else, I'd say even with your investors, try and do that as well.
Maybe just to add something, maybe for the two questions, I think the question is not necessarily what are we doing wrong as founders, but maybe as funders, right? A lot of capital that comes into our ecosystem is from DFIs, development finance institutions, and they have, I think about 70% is the general stat, and they have very clear ideas what development looks like, and therefore what these funds should deploy capital to. And then it largely becomes a deployment game, right? I have to invest in rule this and rule that, and empowerment of this and that under the name of impact. But these are often not models that have a really fair chance to be a VC scalable model, right? And then we invest in these companies. Surprise, they're not scaling like a rocket, right? Because it's hard. You're dealing with customers that don't have a lot of disposable income, that are very costly to get to, right? And then they can't actually raise other rounds from commercial investor because they're simply not set up for that, right? So I think also understanding what drives your investors, what are they looking for, and why are they funding you is really, really important.
Hello, my name is Raz, and I'm CEO and founder of Perima, a Seattle-based company. It's a marketplace for African-inspired products. So, do you guys invest in U.S.-based company that operates on the continent? And the second question is, what type of support do you provide beyond the investments, the financial investments? Thank you.
Okay, just real quick, yes, so we do invest in those types of founders, even founders based abroad, building for Africa, and going back and forth, that's fine as well. In terms of support, it depends on the founder, like I said. Some founders, they want us to be more hands-on. Some founders just okay, take a step back. I don't really need you. But then I think in terms of those that ask for help, what they ask for mainly is around fundraising, around talent, so helping them find devs, helping them find sales reps, or just senior leaders. And then the last part is also just around ops, so how to think about where they want to expand, partners that help with BD and stuff like that.
Amazing. So does any lady, there's been a lot of, no, okay, good, because I refuse to give the mic to at least 4 other people over here okay, perfect. So this is the last question we'll be taking for this panel, and then we'll be moving to the next one.
Hello, my name is Leslie. So just a question. Philippe mentioned that you invest in companies that use tech. So this word comes up a lot in the ecosystem. So what is tech? What's the definition of tech?
Yeah, I mean, that's a big question, I think, one that we could speak about for a while, but for TLcom, it's kind of the words that you hear often, tech-enabled to kind of pure tech and software. So tech-enabled is kind of real world, either brick and mortar or kind of real world applications of non-tech businesses that use tech, either mobile, web-based apps, systems to help, whether it's ERPs or CRMs, et cetera, that helps either drive costs down for operations, increase the affordability of access of their products by selling online or other kind of digital distribution channels, or helps businesses serve end users more efficiently, or aggregates fragmented markets to do the same. We have a very broad definition. We have companies in our portfolio that serve smallholder farmers in very traditional non-tech worlds, but do so with back-end software that helps them internally run their businesses better. And then we have pure AI plays that are building LLMs and the like to offer global products to a global customer base using African technology. So for us, it's everything in between.
Amazing. So